Brad Williams, Frugal Finance, cash flows versus earnings. Yeah, this is going to be a sleeper, but it's important. And I'm just going to go through the same mechanism. I'm going to read this. It's easier for me to read it than it is to just dabble around. So here we go. From accounting earnings to cash flows, I'm going to explain why cash flows are important, as opposed to looking at net earnings. So here we have this example. We're going to use this capital construction, and we're going to have this hypothetical charging company, and does it make sense to do this project? The three variables outlined may cause accounting earnings to change significantly from the cash flows. To get from after-tax operating earnings, which measures the earnings to the company, to cash flows to all investors in the company, we have to include in the operating earnings the total of all non-cash expenses, including amortization and depreciation. Why? Well, because accountants have this tendency to abuse or to manipulate information. We need to clean this up, so we're going to add this stuff back. Remove any and all outflows of cash that correspond to capital costs. Why? Well, because cash has its own earnings capability. We don't want to conflict, overstate. Just want to remove that item. Adjust for variations in accounts payable, inventory, and receivable. Determine the net effect of these non-cash working capital changes. The change will result in a decrease in cash flows if non-cash working capital increased, while an inflow of cash will incur if it decreases. In the first two adjustments, operating earnings are modified to reflect the division made by accountants between operating, financing, and CapEx. In the final adjustments, accrual revenues and expenses are converted to cash. A cash flow to company, earnings before interest and taxes, that would be your EBIT, plus depreciation and amortization, minus change in non-cash working capital, minus CapEx. The cash flow to the company is a pre-debt, after-tax cash flow that measures the cash generated by a project for all claim holders in the company after reinvestment needs have been met. To get from net income, which measures the earnings of equity investors in the company, to cash flows to equity investors, requires the added step of looking at the net cash flow created by repaying old debt and taking on new debt. The difference between new debt issues and debt repayments is called the net debt, and it must be added back to arrive at cash flows to equity. Also, other cash flows to non-equity claim holders in the company, such as preferred dividends, have to be netted from the cash flows. Cash flow to equity is equal to net income plus depreciation and amortization minus change in non-cash working capital minus CapEx plus new debt minus debt repayments minus preferred dividends. The cash flow to equity measures the cash flows generated by a project for equity investors in the company after taxes, debt payments, and reinvestment needs, as opposed to cash flow to the firm. That was right here, cash flow to company. Why are we arguing this? Why don't we just use net earnings? Well, we have the case for cash flows. When earnings and cash flows are different, as they are for many projects, we must determine which one provides a more reliable measure of performance. Accounting earnings, especially at the equity level, net income, can be gained at least for individual periods through the use of innovative accounting practices. A book titled Accounting for Growth, which garnered national headlines in the UK and cost the author Terry Smith his job as an analyst at UBS Phillips and Drew, examined 12 legal accounting schemes frequently used to misinform investors about the profitability of individual companies. To show how innovative accounting practices can increase reported profits, Smith highlighted such companies as Maxwell Communications and Polypec, both of which eventually succumbed to bankruptcy. Cash flow is used for a second, far more obvious reasons. To our knowledge, no company takes earnings and payments for the products and services they provide. All of them need cash. So a project that generates positive earnings but negative cash flows will deplete the funds of the company working on it. On the other hand, a project with negative earnings and positive cash flows might make the accounting bottom line look worse, but will generate cash for the business undertaking it. This is all about cash flows, not earnings. Total versus incremental cash flow. The goal when reviewing a project is to answer the question, will investing in this project make the entire company or business more valuable? So the cash flow we need to look at in the project analysis are the cash flows the project generates for the company or business doing it. We will call these incremental cash flows. Difference between incremental and total cash flows. The total and the incremental cash flows on a project will normally be different for two reasons. First, some of the cash flows on a project might have happened previously and so are unaffected whether we accept the project or not. Such cash flows are called sunk costs and should be removed from the evaluation. The second is that some of the projected cash flows on a project will be generated by the company, whether this project is accepted or rejected. Putting up fixed expenses such as general and administrative costs usually fit into this category. These cash flows are not incremental, and the analyst needs to figure this out and remove them. Sunk costs, there are some expenses tied to projects that are spent before the project review is completed. One example would be expenses linked to a test market done to determine the potential market for a product before doing a full-blown project analysis. Such expenses are called sunk costs since they'll never be recovered if the project is rejected. Sunk costs are not incremental and so should not be included as part of the project analysis. This goes completely opposite of how sunk costs are looked at in terms of accounting statements, which do not differentiate between expenses that have already been spent and expensed. One type of expense that always falls into the sunk cost column in project analysis, research and development, which takes place well before a project is even close to production. Companies that invest large amounts on R&D, such as Merck and Intel, have struggled to come to terms with the fact that the analysis of these expenses generally occur after the fact, when little can be done about them. Even though sunk costs should not be included as part of the project review, the company must make up for its sunk cost over time, or it will eventually fail. Consider, for example, a company like McDonald's who spent a ton of money test marketing fast foods before introducing them. Imagine on the ill-fated McLean Deluxe, a low-fat hamburger introduced in the 90s, that the test market expenses amounted to $30 million and the net present value of the project determined after the test market amounted to $20 million. The project should be done. No, it shouldn't be done. But McDonald's will crumble under the weight of its test marketing cost if this is the pattern for every project it undertakes. For a project to be successful, its successful project's cumulative net present value must be greater than the total test marketing cost for all of its products, successful and unsuccessful. Allocated cost. An accounting method manufactured can guarantee that every part of a project bears its fair share of cost is allocation, where expenses that are not directly traceable to revenues generated by individual products or divisions are allocated across these units based on revenues, profits, or assets. Even if the purpose of such allocations might be fairness, their effect on project analysis have to be reviewed in terms of whether they create incremental cash flows. An allocated cost that will exist with or without the project being reviewed does not belong in the project analysis. An increase in administrative or staff costs that can be traced to the project is an incremental cost and belongs in the analysis. One way to calculate the incremental components of these costs is to break them down on the basis of whether they are fixed or variable, and if variable, where do they come from? So a slice of administrative costs could be linked to revenue, and the revenue projections of a new project can be used to estimate the administrative costs to be assigned to it. Example 2.1, dealing with allocated costs. Case 1, imagine that you're looking at a retail company with general administrative costs currently at $1 million a year. The company currently has 5 stores and the G&A costs are allocated evenly across the stores. The allocation to each store is $200,000. The company's considering opening a new store with 6 stores. The allocation of G&A expenses to each store will be $166,667. Here, assigning an expense of $166,667 for G&A cost to the new store in the project analysis would be a mistake because it is not an incremental cost. The total G&A cost will be $1 million, whether the project is taken or not. Case 2 in the previous analysis, suppose that all the facts remain unchanged except for one. The total G&A costs are expected to increase from $1 million to $1.2 million as a consequence of the new store. Each store is still allocated an equal amount. The new store will be allocated 1/6 of the total cost, or $200,000. In this case, the allocated cost of $250,000 should not be considered in the project analysis for the new store. The incremental cost of $200,000, $1.2 million minus $1 million, however, should be considered as part of the analysis. In 2021, Granite Construction's corporate shared costs amounted to $353 million. Assuming that these general administrative costs serve a purpose, which otherwise would have to be borne by each of Granite's construction businesses, and there is a positive relationship between the magnitude of these costs and revenues, it seems reasonable to argue that the company should compute a fixed charge for these costs that every new project has to cover, even though this cost may not occur immediately or as a direct consequence of the new project. Who will pay for the headquarters? As in the case of sunk costs, the right thing to do in project analysis, considering only direct incremental costs, may not add up to create a company that is financially healthy. Thus, if a company like Granite Construction does not require individual projects that it reviews to cover the allocated costs of general administrative expenses of the transportation division, it is difficult to see how these costs will be covered at the level of a company. The case for incremental cash flows: when reviewing projects, it is easy to get tunnel vision and focus on the project or investment at hand, acting as if the goal of the exercise is to maximize the value of the individual project. There is also the tendency, with perfect hindsight, to require projects to cover all costs that they have generated for the company, even if such costs will not be recovered by rejecting the project. The objective in project analysis is to measure the value of the business or company taking the project. Consequently, it is the cash flow that a project will add in the future to the business, that is, the incremental cash flows, that we should focus on. Example 2.2, estimating cash flows for a retail door company, Capital Construction. As described in example 2.1, Capital Construction is considering starting a door company, which will be staffed by one part-time employee. The following estimates relate to the cost of beginning the project and the revenues from it. The initial funding required to start the door company, including adding high-speed internet, software, computers, and office equipment, will be $50,000. These assets are expected to have a life of 4 years, at which point they will have no salvage value. The assets will be depreciated straight line over the 4-year life. The revenues in the first year are expected to be $60,000, growing 60% in year 2 and 10% in the 2 years following. The salary and other benefits for the employee are estimated to be $10,000 in year 1 and grow 10% a year for the following 3 years. The cost of the doors is supposed to be 60% of the revenues in each of the 4 years. The working capital, which includes the inventory of doors needed for the company and the accounts receivable associated with selling doors on credit, is expected to amount to 10% of the revenues. The cash for working capital has to be made at the beginning of each year. At the end of year 4, the entire working capital is supposed to be salvaged. The tax revenue on income is expected to be 25%, which is also the marginal tax rate for Capital Construction. Based on this information, we calculate the operating income of Capital Construction Door Company as shown in worksheet 2.3. Here we go. We have our revenues, $1.5 million, incrementing at the 15% or whatever that number is over the 4-year life. Our labor, $150. Our materials, our depreciation, our operating income, our taxes, and then our after-tax operating income. I left the formulas blank so you can go in and change these on your own. To get from operating income to cash flows, we normally add back the depreciation charges and subtract the working capital requirements, the changes in working capital year to year in worksheet 2.4. We also show the initial funding of $150,000 as cash outflow right now, year 0, and the salvage value of the entire working capital requirements in year 4, right here. Here it is. This is our after-tax cash flows. After-tax operating income, $120. Here we have our outflow. That's to get this thing started. We have our operating income. We're going to add back depreciation, subtract out working capital. Salvage value 0 at $340. here's our after-tax cash flow. Note, there is an initial working capital requirement, which is 10% of the first year's revenue, funded at the beginning of the year. Each subsequent year has a change in working capital that represents 10% of the revenue change from year to year. In year 4, the cumulative working capital cash requirements over the 4 years, 8712, is salvaged, resulting in a positive cash flow. Salvaging working capital is basically the same as having a going out of business sale where all the inventory is sold at cost and all accounts receivable are collected. Example 2.4, estimating earnings, and incremental cash flows, Granite Quick Charge. Here's another hypothetical, and we're going to look at Granite Construction, and they think the future is quick charge battery powered construction equipment and believes there's a strong market for quick charge construction battery chargers. Granite will sell the quick charge construction battery chargers to retail and its U.S. construction partners. It will purchase the chargers from 3 recognized U.S. quick charge construction battery charge manufacturers. Granite plans to build a 100,000 square foot warehouse beginning immediately. The project will take 1 year to plan and to construct. A second warehouse, Warehouse 2, will be constructed in the second and third year and become operational at the beginning of year 4. A third warehouse will be constructed in the third and fourth year and become operational at the beginning of year 5. The cash flows will be calculated in nominal dollars, even though the actual cash flows will be in Mexican pesos. The cost of building Warehouse 1 will be $3 million, with $2.5 million to be spent right now and $0.5 million to be spent a year from now. Granite has already spent $100,000 researching the project and getting the necessary licenses for the warehouse. None of this cash can be recovered if the warehouse is not built. The amount will be capitalized and depreciated straight line over the 10 years to be salvage value of 0. The cost of building a second warehouse, Warehouse 2, will be $5 million and $3.5 million spent at the end of the second year and $0.5 million at the end of the third year. The revenue for the 2 warehouses are assumed to be the following, based on projected demand figures until the 10th year and an expected inflation of 1.29% in US dollars. Beginning year 10, sales are expected to grow at the inflation rate. Worksheet 2.6 summarizes the revenue projection. Here we have the Warehouse 1, Warehouse 2, Warehouse 3, so on and so forth. We have the totals, the revenue growth, and you can go ahead. I didn't use any formulas here. I just hard-coded this stuff from another example, but go ahead and change this if you want. Note that the revenues at Warehouse 3 property is set at 25% of the revenues at Warehouse 1. The direct operating expenses are supposed to be 80% of the revenues at Warehouse 1 and 85% of revenues at Warehouse 2. The amount of depreciation on fixed assets will be determined as a percentage of the assets remaining book value at the end of the preceding year. Additionally, the warehouses will require capital maintenance costs contributions each year, specifically as a percentage of depreciation that year. Worksheet 3.6 shows depreciation as noted above and capital expenses as a percentage of depreciation. The capital maintenance expenses are low in the early years when the warehouses are still new, but increase as the warehouses age since old warehouses have to go through either major renovations or be replaced with new materials. After 10 years, both depreciation and CapEx are supposed to grow at the inflation rate. Granite Quick Charge will also allocate corporate G&A costs to this project based on revenues. The G&A allocation will be 15% of the revenues each year. It is worth commenting on that a recent study found that only 1/3 of these expenses are variable and a function of total revenue, and that 2/3 are fixed. After year 10, these expenses are also supposed to grow at the inflation rate of 1.29%. Granite Quick Charge will have to maintain non-cash working capital, primarily consisting of inventory at the warehouses, netted against accounts payable of 5% of revenue, with the cash contribution being made at the end of each year. The income from the project will be taxed at Granite Construction's marginal tax rate of 25%. The project operating earnings at the warehouses starting in the first year of operations, which is the second year, are summarized in Worksheet 3.1. Note that the project has no revenues until year 2, when the first warehouses become operational, and that the project is expected to have an operating loss of $2.5 million in that year. We have assumed that the company will have enough income in its other businesses to claim the tax benefits from these losses, 25% of the loss, in the same year. Had this been a standalone project, we would have needed to lower taxes on those years and carry forward the losses. The estimate of operating earnings in Worksheet 3.1 are distorted because they do not mix together expenses that are incremental with expenses that are not. Specifically, there are 2 points of disagreement. Pre-project funding, we included the depreciation on the pre-project funding of $100,000 in the total depreciation for the project. This depreciation, though, can be used by Granite Construction regardless if it goes ahead with the new quick charge project. Allocated G&A, while we consider the total allocated expenses in computing earnings, only 1/3 of these expenses is incremental. As a result, we are understating the earnings on this project. In Worksheet 2.9, we computed the incremental earnings for Granite Quick Charge using only the incremental depreciation and G&A expenses. Note that the incremental earnings are more positive than the unadjusted earnings in Worksheet 2.1. In Worksheet 2.2, we also determined the incremental after-tax cash flows to Granite Construction prior to debt payments by adding back the incremental depreciation each year because it is a non-cash charge, subtracting out the maintenance capital expense along with the primary CapEx since these are cash outflows. Subtracting out the incremental cash contributions in working capital each year, which represents the change in working capital from the prior year. Here, we have assumed that the working capital cash contributions are made at the end of each year. The funding of $3 million in Warehouse 1 is shown at time 0 as $2.5 million and as year 1 as $0.5 million. The expense, $0.1 million, pre-project funding is not considered because it has already been made. It's a sunk cost. To correct for the non-incremental items, adding back the fixed portion of G&A cost and deducting the tax benefits from non-incremental depreciation, we could have started with the unadjusted operating income and arrived at the same estimates of incremental cash flow. The proof is given in Worksheet 2.10. So here, what I just discussed is illustrated in this example. You can go through and you can reconcile this information and you can end up with the operating income and your operating income after taxes. Then you're going to come up with the various offsets. To compute book value of fixed assets, we took book value of fixed assets, T-1 plus new investments, plus capital maintenance minus depreciation. Depreciation on fixed assets, book value of fixed assets times depreciation as a percentage of the prior year's book value of fixed assets, and then depreciation and amortization, pre-project investment plus depreciation on fixed assets. Here is a overview of what we discussed up right here. And then we have 2.10, which is another way of determining cash flows, just a different reconciliation. You can work through this as I just explained. Go back through here and read this information again. You can come up with these cash flows to firm, where we're just going to take your revenues, minus your direct expenses, minus incremental depreciation, minus incremental G&A. We have our operating income. We're going to get rid of the taxes. We have incremental after-tax operating income. Then we're going to add back incremental depreciation. We're going to subtract CapEx and change in non-cash working capital. Here again is a similar method. We have the year, we have operating income minus taxes. Operating income, we're going to add back the depreciation and amortization. We're going to subtract pre-project depreciation minus CapEx minus working capital, and we're going to add back allocated expenses. And you're going to see they come out with the same conclusion. So project decision rules, having calculated accounting earnings, cash flow, and time-weighted cash flows on a project, we're still faced with the important decision. Did we take the project or not? In this section, we'll look at a number of project decision rules and put them to test. When dealing with new investments and projects, companies have to decide whether to invest in them or not. We've been leading up to this decision over the last few sections, but project decision rules allow us to formalize the process and identify what conditions need to be satisfied for a project to be acceptable. Although we will be looking at a variety of project decision rules in this section, it is worth keeping in mind what characteristics we would like a good project decision rule to have. First, a good project decision rule has to maintain a fair balance between allowing a manager reviewing a new project to bring in his or her subjective opinions into the decision making and ensuring that different projects are judged consistently. So, an investment decision rule that is too mechanical by not allowing for subjective inputs or too malleable, where managers can bend the rules to match their biases, is not a good rule. Second, a good project decision rule will allow the company to further the stated objective in corporate finance, which is to maximize the value of the company. Projects that are acceptable using the decision rule should increase the value of the company accepting them, whereas projects that do not meet the requirements would destroy value if the company invests in them. Third, a good project decision rule should work across a variety of investment. Projects can be revenue-generating projects such as Home Depot's opening a new store, or they can be cost-saving projects, as would be the case if Boeing adopted a new inventory management system. Some projects have large upfront costs, as in the case with the Boeing 770 aircraft, whereas other projects may have costs spread across time. A good project decision rule will give an answer to all of these specific types of projects. Does there have to be only one project decision rule? While many companies review projects using any number of different project decision rules, one rule has to govern. In other words, when the project decision rule leads to different conclusions on if the project should be accepted or rejected, one decision rule has to be the tiebreaker and can be viewed as the governing rule. This information is intended for general information purposes only and should not be construed as legal or financial advice or legal or financial opinions on any specific facts or circumstances. This is a lead-in to the next 5 sections within this course. My suggestion is read it, reread it if you need it. I left this information without any formulas. I did it on purpose. I want you to go back and review this information, review these notes on your own, and see how it calculates and see how this reconciles. Brad Williams, Frugal Finance. Thanks for watching. See you soon.